Morning, everyone. Welcome to our second quarter 2018 earnings call. Before we start, let me very briefly welcome our new head of investor relations, Sadrettin Bajı, who is also with us on this call, and whom many of you may know from his former years as a senior analyst with Deniz Invest. I'd also like to take this opportunity to shed light on the fact that this is the first earnings call being live streamed on our very own YouTube channel. We thought doing so would be a good way to reach out to more of our stakeholders and to make sure we continue to focus on increasing access to our organization. So, to all of those whom are joining us this morning, we are glad, of course, to have you with us. And now, having said that, let us, as is always customary, jump straight into things. So let's begin very briefly on pages 4 and 5, or slides 4 and 5, which is Turkey macroeconomic developments. As many of you know, Turkish growth grew around 7.4% last year, its fastest annual rate since about 2013. Thanks in large part to robust growth in domestic demand and an expansion in output, services, and construction. A series of pro-growth stimulus measures, in fact, towards the end of last year, naturally played a critical role in providing the tailwinds for economic growth, with fourth quarter growth closing at around 7.3% year-on-year. In the first quarter of this year, the Turkish economy again grew by an impressive 7.4% year-on-year, driven in large part by resilient private consumption, growing investments, and public spending. Now, from today's vantage point, as we look forward to the rest of 2018, growth is expected to rebalance. Inflationary pressures, recent FX movements, tighter liquidity conditions, and a slowing down in domestic demand are all playing their respective parts in contributing to expectations of such a rebalancing in Turkish growth as we move through the second half of this year. Inflation-wise, annual CPI was about 15.4% in June. That represented about a 2.61% month-on-month change. Inflation topping 15% last June was in fact the highest level we had seen here in Turkey in almost 15 years. The major contributors to this were, of course, broad price increases related to fairly broad-based categories. Transportation costs were up, furnishings and household equipment were up. The largest contributor was food and beverages, where costs were up roughly about 19% year-on-year. Now, when we look at the core index, which excludes energy and unprocessed food, this rose about 14.6%. And in essence reflecting the ongoing pass-through effect from a weaker Turkish lira onto consumer prices. As we look forward towards the remainder of 2018, volatile food prices, the path of crude oil, exchange rate movements, fiscal policy, I think will all continue to shape inflation expectations in Turkey. According to the central bank, inflation is expected to close the year at around the 13.5% level. With regards to the Turkish lira, I think we're all fairly aware of the fact that the lira has depreciated roughly 21% versus the dollar in the first half of this year, 18% versus the euro during that same period, and of course substantially down a bit more in terms of where we stand today. I think concerns surrounding the recent spike in inflation, tightening U.S. monetary policy, and a sell-off in emerging market currencies have all contributed to sentiment, which is certainly weighing in on the lira. As we approach end of the year, I think the path will largely be based on how a lot of these early sort of mentioned factors play out. In addition to this, the extent to which discipline on the fiscal side is maintained, how geopolitics evolves, and the expected impact of the current monetary policy stance on inflation here, I think will be critical factors. Initial statements from policymakers indicate that there will be a focus on a disciplined fiscal budget and maintaining the status quo on tight monetary policy for some time to come. In terms of central bank monetary policy, I think we can all agree it's been quite an action-packed first half of the year for the central bank. The one-week repo, which was our policy rate up until January of last year, was reopened in May of this year at a new rate of 16.5% and was subsequently increased by around 125 basis points to 17.75%, which is effectively where it stands today as our main funding and policy rate. Central bank overnight lending and borrowing rates were in turn set at 150 basis points above and below the one-week repo, while the late liquidity window was raised to 20.75%. So the wave of monetary policy tightening that we have witnessed towards the end of the second quarter especially, and the current stance of maintaining tight monetary policy by the central bank is expected to persist until the central bank does see more comfort with the inflation figures. And I'll just very briefly touch on the current account deficit and budget balance. The current account deficit widened by about $516 million as of May. It's today at around $5.89 billion, whereas the 12-month sort of cumulative deficit reached about $57.6 billion, up from $55.4 at the end of the first quarter of 2018. The widening of our deficit continues to be impacted by rising commodity prices, especially oil, as well as rising imports related to raw materials and equipment. Looking forward, the current account will continue to be impacted by the degree to which economic growth rebalances, coupled with stronger tourism revenues, slowing imports, which we believe should all kind of help offset some of the pressures contributing to this widening. And on the budget balance, the Turkish government recorded a deficit of around 25.6 billion liras in June. This was actually a significant year-on-year increase, primarily due to increasing public expenditures ahead of the recently concluded elections. A number of those expenditures played a role in pushing up the budget gap in June. The 12-month rolling budget deficit rose to around 2% of GDP versus the 1.9% target for this year. If we move on to slide 7, in terms of how the overall banking sector in Turkey performed in the first half of the year, as well as how the participation banks sort of performed. So if we take a look at the aggregate or consolidated balance sheet of the banking sector at large at the end of the first half of this year, what are we seeing? Total deposits grew around 12%, total loans grew around 13% year to date. And when we look at the currency denomination breakdown of this growth, what we've noticed is that Turkish lira deposits grew 6.4%, while foreign currency deposits, in fact, declined 1.9% in real terms. Turkish lira loans grew 7.9%, while foreign currency loans grew 2.2% in real terms. Outstanding NPL volumes have increased 12% in the second quarter of this year, compared to around 2.6% in the first quarter. Year on year, this translates into about 20% growth in outstanding NPLs. The current NPL ratio stands at around 3.03% for the second quarter for the banking sector at large, representing roughly around 13 basis points widening from the first quarter of this year. In terms of the participation banking sector, when you look at our own sort of balance sheets at the end of June 2018, it compares as follows. Total deposits grew around 18.2%, total loans grew around 17.5% year to date at the end of the first half. And when we also look at the currency denomination breakdown of this growth, what we see is that the Turkish lira deposits grew 7.8%, while foreign currency deposits grew 7.7% in real terms. Turkish lira loans grew roughly around 10%, while foreign currency loans grew around 26.3%, again in real terms. As for outstanding NPL volumes, those have increased 8.8% in the second quarter compared to 10.2% in the first quarter. Year on year, this translates to 9% growth in outstanding NPLs. Our own sort of cumulative current NPL ratio stands at around 3.53% for the second quarter compared to 3.48% for the first quarter. So in terms of overall banking sector performance, I think several dynamics made it a more challenging period. Obviously, FX volatilities are naturally creating uncertainties, while the movement in Turkish lira deposit costs for financial institutions, as well as a rise in foreign currency funding costs, is also impacting aggregate cost of funding levels. Despite these factors, the Turkish banking sector, by global standards, still remains fairly well capitalized, with a capital adequacy ratio of 16%. Earning-wise, the Turkish banking sector had around 15 billion liras in net income for the second quarter. This represented a 7% increase quarter on quarter and a 23% increase year on year, with ROE at around 15.5%. The participation banks did record a stronger net profit growth compared to the overall banking sector, recording a 28% quarter on quarter increase and a 53% year on year increase with regards to quarterly ROEs hovering at around 18%. Net profit share margins also expanded 20 basis points quarter on quarter, while cost growth was controlled with a mere 13% year-on-year change, mostly coming from inflation impact. As a sector, we also witnessed strong fee generation, as evidenced by a 20% change year-on-year. And all in all, this did in aggregate help to support a healthy bottom line despite the declining asset quality related rise in provisioning expenses. So when it comes to relative growth, the participation banking sector continues to outpace the overall banking sector in terms of deposit and loan growth. Loan growth across the banking sector has slowed down in the second quarter, and deposit growth has also shown some signs of slowing down. The banking sector related asset quality figures in terms of flow of incoming NPLs for the second quarter do reflect a buildup in asset quality and some asset quality pressures. However, the participation banking sector, we believe, is generally doing better than the banking sector at large, as the incoming NPL growth year on year for our sort of segment was 9%, That was roughly about half of sort of the level for the banking sector, where year-on-year growth in incoming NPLs was around 20%. So now moving on to our own financial results on slide 10, which is balance sheet highlights. With regards to our balance sheet highlights for the second quarter of 2018, total assets grew roughly around 18.2% year-on-year and 11.7% year-to-date to reach 40.5 billion liras. Total funded credits, our loan book, grew around 21% year-on-year and 10% year-to-date to reach 27.7 billion liras. Total deposits grew roughly 16.6% year-on-year and 9.5% year-to-date to reach 27.7 billion liras. Total shareholders' equity grew roughly around 38% year-on-year and 32% year-to-date to reach 3.3 billion liras. Let me also very briefly discuss the asset segmentation graph on the lower right-hand corner you can see here. So our loan portfolio continues obviously to represent the core part of our assets, 68.4%. The securities portfolio represents now around 6.6% of total assets, and our liquid assets roughly represents around 22%. Now, with regards to liquid assets, our cash balances with the central bank and interbank placements increased about 22% year-to-date to reach 8.8 billion liras in the first half. Roughly 12% of these liquid assets are Turkish lira denominated, while 88% are foreign currency denominated. The securities portfolio, as I had mentioned earlier, now represents 6.6% of all assets. That has actually declined roughly 8% year-to-date in terms of volume to reach about 2.7 billion. Roughly 62% of the portfolio consists of high-quality liquid Turkish treasuries. In terms of currency breakdown, roughly 86% of the portfolio is lira denominated, while foreign currency represents roughly 14%. Size-wise, our securities portfolio has somewhat declined on the back of the fact that, in line with the tight lira situation, we have selectively been shifting our proceeds from some maturing sukuk assets to cash. In terms of slide 11, which is our income statement highlights for the standalone second quarter, profit share income, or headline profit share income, grew roughly 8.6% quarter-on-quarter and 10% year-on-year to reach 720 million. Net profit share income contracted roughly 0.5% quarter-on-quarter and declined 22.6% year-on-year to reach 249 million liras. Operating profits contracted roughly 22.3% quarter-on-quarter and increased 11.3% year-on-year to reach 464 million. Provisions for loan losses declined considerably by around 63% quarter-on-quarter and were relatively flat year-on-year to reach 96 million. This isn't really surprising, since a lot of the IFRS 9 related changes to provisioning were all sort of front-loaded in the first quarter of the year. And gradually, as we sort of progress, that will significantly start to come down related to IFRS 9. Net operating profits increased 12.1% quarter-on-quarter and 11.1% year-on-year to reach 129 million liras. Net profits remained flat both quarter-on-quarter and increased by 3.1% year-on-year to reach 98 million liras. So if you look at our sort of also bottom right-hand corner graph related to the net profit share margin, both on a sort of blended basis as well as in terms of excluding joint venture projects, our last 4 quarters trading net profit share margin has declined 36 basis points quarter-on-quarter and 57 basis points year-on-year to reach 335 basis points. However, if we extract joint venture income from these figures, our actual net profit share margin declined 5 basis points quarter-on-quarter and 39 basis points year-on-year to reach 314 basis points. This obviously is due to the fact that we didn't record, in fact, any income from joint ventures in the first half of 2018 as opposed to prior periods. If we move on to slide 12, which is asset composition, I touched on these a little bit earlier when covering the balance sheet highlights. Let me just sort of add 2 or 3 small details. Asset composition has not structurally changed. The loan book is still, as I mentioned earlier, the big part of assets. The securities portfolio, as I also mentioned earlier, has come down to around 2.65 billion liras. Now, liquid assets, including our securities portfolio, represents around 27% of all assets. This is a reflection of our focus right now on maintaining liquidity. In fact, if you look at sort of the period of the first half of 2018, our average liquidity coverage ratios on both foreign currency as well as foreign currency and local currency, were about 211% and 145% respectively. These were obviously well above the regulatory requirements of 70% and 90% respectively. The yield on the securities book has increased 113 basis points over the last year and 24 basis points over the last quarter alone to reach about 10.02%. If we move to slide 13, operating performance highlights. So with regards to this area, I'm going to go into a bit more details and spend some time here sort of individual line item by line item on both the income side as well as the expenses side. But let me very briefly begin with cost and yield movement first, which is also on the bottom right hand side. So loan yields declined 14 basis points Q on Q and 6 basis points year on year to reach 10.04%. Cost of collected funds, not surprisingly, has increased 25 basis points quarter on quarter and 77 basis points year on year to reach 6.13%. Net profit share margin has subsequently declined 36 basis points quarter on quarter and 57 basis points year on year to reach 3.35%. If we look at the blended loan book yield breakdown, after we adjust for some joint venture projects, as I had mentioned earlier, and FX indexed loans as of the second quarter, our loan yield was actually 10% roughly, representing a 40 basis points increase from the first quarter of this year. Over this same period, Turkish lira loan yields increased 10 basis points to reach 13.6%, while foreign currency loan yields increased 60 basis points to reach 7%. Headline profit share income for the standalone second quarter of this year increased 10% year on year to reach 720 million, whereas when you look at our first half of 2018 headline profit share income, this figure was about 1.38 billion. That also represented a 7.3% increase compared to the same period last year. Now, in terms of breakdown of this sort of headline profit share income, income from our loan book represents roughly 90% of all income. If we look at the core business, profit share income from the loan book increased about 11% from the second quarter of last year to this second quarter of this year, reaching 643 million liras. As for the first half 2018 figures compared to the same period of 2017, that increase was roughly around 9%, reaching 1.23 billion. Income received from our securities portfolio now represents 7% of all income. In comparison to the first half of last year, our total income from securities in the first half of this year naturally declined 8% to reach 95.5 million. This was, as I mentioned earlier, marginally due to the fact that our size of our securities portfolio has somewhat contracted, albeit by a very sort of marginal level. On a standalone basis, the second quarter 2018 witnessed a 4% decline to reach 51 million compared to the same quarter of last year. Now, in terms of profit share expenses, headline profit share expenses for the standalone second quarter of this year increased 41% year on year to reach 471 million liras, while our first half 2018 headline profit share expense was 884 million, representing a 36% respective increase. In terms of breakdown, expenses related to our profit sharing customer deposit accounts represent 70% of all our profit share expenses. These expenses increased 29% from the first half of last year to the first half of this year, reaching 617 million. On a standalone basis, we paid out profits of about 323 million liras during the second quarter on a standalone basis. This also represented obviously a 29% year-on-year increase and naturally came from the increases in our cost of funding. Our blended deposit cost has increased 26 basis points to reach 6.48% if we factor in current accounts impact. Turkish lira deposit cost has increased 64 basis points from last quarter to reach 8.1%. Foreign currency deposit costs has increased 21 basis points from last quarter to reach 2.38%. Now, expenses related to wholesale funding now represent 26% of all profit share expenses. Our profit share expenses on wholesale borrowings or funds collected increased year on year roughly 48% as of the first half of this year to reach 231 million liras, while reaching 127 million liras for the standalone second quarter. This is a jump that is attributable, in my opinion, to some one-offs as well as some other factors. As you all know, during the second quarter of this year, we had conducted some activity in the global markets as it relates to repaying our Tier 2 sukuk and issuing a new Tier 1 sukuk. These one-off transactions, or relatively one-off transactions, carried certain costs, legal fees, for example, which were all recognized in the second quarter. Of course, these were not the only factor. We are also witnessing somewhat of an increase in funding costs related to foreign currency borrowings. This also applies to our last syndication, where we were able to have a rollover ratio of 150%, but ultimately had to pay a bit higher fees, so to speak, to investors. In addition to this, given the increase in our domestic Turkish lira sukuk issuances, as these issuances have gradually been representing a greater share of our overall funding, the ongoing expenses pertaining to these issuances is also sort of adding some pressures on the overall expenses side. Obviously, there's also the inflation sort of impact in terms of the expenses side, which should be factored in. Net profit share income dropped 22% from the first half of last year to the first half of this year, reaching about 498 million, while dropping by a similar percentage for the standalone second quarter, reaching about 249 million liras. It is worth mentioning here that we had about 126 million liras in profit share income from revenue sharing joint venture projects in the first half of last year, whereas we in fact recorded no income from this area in the first half of this year. And as I had also sort of mentioned earlier, our adjusted net profit share margin, excluding joint venture projects, dropped by only 5 basis points quarter on quarter, while our reported net profit share margin in aggregate was down about 36 basis points quarter on quarter. And that shows you the sort of impact that the joint ventures had, obviously, on the net profit share margin. In terms of other notable income statement line items, net fees and commissions increased 15% year on year to reach 85 million for the first half, while the increase was 25 basis points to 45 million liras when comparing the standalone second quarter of this year to last year. Now, net fees related to non-cash credits and banking operations income did well due to the continued growth of our off-balance sheet business, which helped to somewhat offset the lower than expected fees from the cash loan business. In terms of trading income, our trading income for the first half of this year increased almost sevenfold to reach 146 million liras, with about 112 million of this recognized in the second quarter alone. The major contributor to this trading income was about 125 million liras in income generated from an FX position stemming from our Tier 1 Sukuk transaction, and about 28 million resulting from capital markets gains income. Those incomes are generally coming from revaluation of our Sukuk book, revaluation of real estate securities, and share buyback program gains. In terms of other operating income, our other operating income came in at around 331 million for the first half of this year and 58 million for the second quarter of this year, representing a 417% increase and 70% increase from the respective periods last year. The major factors here, as all of you certainly know, was a reversal of prior year provisions of around 304 million liras during the first half of this year, compared to around 45 million for the same period in 2017. So most of the sort of prior year provisions were also sort of front-loaded in the first quarter. Now, total operating income was about 804 million for the first half of this year and 329 million for the second quarter, representing a 1% increase and 21% decline from the same periods last year. Again, the key factors here, year-on-year comparison for the first halves, has been a decline in our net profit share income, which has been somewhat offset by a material increase in trading gains and increase in reversals of prior year sort of provisions. In terms of provisions for loan losses or expected credit losses, provisioning was about 352 million for the first half and 96 million for the second quarter. This represented a 50% increase and 1% decrease from the same period last year. Given that we are now reporting these figures in line with IFRS 9, let me give you the breakdown of our provisioning for the first half of 2018. So stage 1 or 12-month expected credit loss coverage was about 17 million liras. That corresponds to about 0.3% coverage rate. Stage 2 or significant increase in credit risk provisioning was about 40 million liras. This represents a 5.7% coverage rate. Stage 3 for non-performing loans was about 289 million liras in terms of provisions. This represents a 57.7% coverage rate. And for other areas like non-cash related loans, for example, about 7 million, so all in about 352 million. In terms of other operating expenses, our other operating expenses, factoring personnel expenses, which is now a separate line item, was about 464 million for the first half and 239 million for the second quarter of this year, representing a 15% increase from the same respective period last year. A significant part of these increases was high inflation-driven cost growth, but besides this, we have seen, generally speaking, decent cost control management in this regard. Net operating income was 244 million for the first half and 129 million for the second quarter of this year, representing a 50% increase and 11% increase from the same respective periods last year. Tax provisions was roughly 48 million for the first half and about 30 million for the second quarter of this year. These represent 56% and 50% respective increases. Last but certainly not least, net income was about 196 million for the first half liras and about 98 million liras for the standalone second quarter of this year, representing a 49% year-on-year increase in the first half figures, while representing a 3% sort of higher figure in terms of the same quarter of last year. Let me also move on to the funded credits portfolio, which is slide 14. Our blended loan book grew about 10% in the first half of this year to reach about 27.7 billion. This also represented a 21% year-on-year change and 6.7% quarter-on-quarter change. This was slightly lower than the overall banking sector, which, as I had mentioned earlier, recorded about a 13% growth in the consolidated loan book. Our lira loan book grew 3.4% year-to-date to reach about 13.6 billion liras, whereas the foreign currency loan book grew 9.3% year-to-date in real terms to reach $1.8 billion. FX indexed loans, mostly due to the regulation change, which took effect, as many of us know, in early May of this year, contracted by about 15.8% year-to-date to 1.3 billion, which is not particularly surprising. When we compare this to the year-to-date loan growth of the banking sector at large, our lira loan growth was more, I would say, cautious, while when we benchmark ourselves to the year-to-date foreign currency loan growth of the banking sector at large, which stood at 2.2% in real terms, we did out or overperform. Now, there are obviously several factors at play here. Our cautious lira loan growth is naturally tied to a fairly tight lira deposit growth at the moment. Loan-to-deposit ratios, particularly for the lira, are somewhat more stretched on the back of previous lending that took place under the Credit Guarantee Fund, as many of us know, whereas the banking sector at large, as of the first half of this year, had an aggregate loan-to-deposit ratio of 119%, of which 148% was for their lira and 88% for foreign currency. Our aggregate loan-to-deposit ratio at Albaraka Turk was about 100%, with lira loan-to-deposit standing at about 151%, and our foreign currency loan-to-deposit ratio standing at 55%. So in the wake of existing, obviously, loan-to-deposit ratios, specifically on the lira side, and due to the increase of incoming NPLs witnessed by the sector in the second quarter, we are adopting a more measured tone now with regards to loan expansion. In terms of ourselves, I think until we see lira liquidity levels normalize somewhat, our lira loan growth will continue to be somewhat impacted. On the foreign currency side, our foreign currency loan-to-deposit ratio is much lower than the market, which reflects our emphasis on maintaining hard currency liquidity in our short-term treasury coffers. This is also giving us some flexibility in terms of generating a Turkish lira vis-a-vis our swaps mechanism. In terms of yields on our performing credits, if we look at our adjusted trailing yields on Turkish lira credits, these have remained relatively flat from the second quarter of last year to second quarter of this year. In fact, if we compare this to the average increase for some of the top Turkish banks, their trailing 4 quarters Turkish lira loan yields increased on average by about 104 basis points. So our blended yield has slightly increased over the last 12 months, whereas the yield on our foreign currency denominated credits, which includes foreign currency loans as well as foreign currency indexed loans, increased by about 1.1% over the last 12 months. In terms of the customer segment composition of the overall funded credits, corporate credits are now 39.6%. SME credits have increased to around 49.2% of the loan book. Retail credits have declined to around 11.2%. With regards to currency denomination of the loan book, 49% of the loan book is lira, whereas the remainder is foreign currency. In terms of slides 15 and 16, which is asset quality assessment, let me also spend a brief time here, since this is, I know, is an important area. Our NPL ratio inched up from 5.34% in the first quarter of this year to 5.57% at the end of the second quarter of this year. It is worth noting that we had no NPL sales and no write-offs so far in the first half of this year. NPL inflows continued in the second quarter, but at a decelerating pace. I think we performed better both compared to our previous performance and compared to the banking sector average. We had about 209 million liras NPL inflow and about 44 million lira collections in the second quarter. This basically resulted in a net NPL inflow of 165 million. So when we compare this obviously to last quarter, it is lower than the 231 million that we witnessed. Therefore, though it is certainly still high in absolute terms, the net NPL formation rate has declined to 250 basis points in the second quarter of this year from 372 basis points in the previous quarter. This does, of course, still represent figures that are higher than we actually like. Now, when we look at the sector distribution of the NPL inflows in terms of the customers' industry classification during the first half of this year, the inflows are generally as follows. Roughly 28.5% are coming from manufacturing sector, about 21.7% are coming from trading sector, about 18.6% coming from construction and real estate, about 17.4% coming from the energy sector, and about 13.9% sort of other areas. So although we do see the energy and construction sectors as the main areas where the banking sector has been recording NPL related inflows from in the first half, the inflows related to our NPL book have generally originated from SMEs in the manufacturing industry and wholesale trade. Now, if we take a look at our gross funded credits by stage, what we see is our loan book in terms of stage 1 credits, those without any significant credit risk increase according to IFRS 9 now represents about 81.5% of the total gross funded credits, a decline of 6.1% from the second quarter of last year. Our loan book in terms of stage 2 credits, those which have witnessed a significant increase in credit risk since initial recognition, now represent around 12.9%, 13% of the gross loan portfolio. This represents an increase of 6.5% from the second quarter of last year. Our loan book in terms of stage 3 credits, those which are impaired, now represents around 5.6% of the loan book, a decline of around 0.3% since the second quarter of last year. So what we see in terms of migration is that our NPL book at the moment as a percentage of the overall loan book has not really changed over the last year. The biggest change has been the migration of loans from stage 1 to stage 2, which mostly took place in the first quarter. Some, of course, which had also been due to IFRS 9, as many of you know, and to a lesser extent currently in the second quarter. In terms of the provisioning ratio, our provisioning ratio has increased roughly 300 basis points from the second quarter of last year to the second quarter of this year, and we registered around 57.7% coverage ratio, which is below industry standards, but which we're fairly comfortable with given our high collateralization policy for our loan portfolio. In terms of cost of risk, our cost of risk has declined from 243 basis points last quarter to 227 basis points for the second quarter of this year. Now, if we move to slide 17, the funding profile, specifically wholesale funding, I had mentioned earlier, now represents 21.2% of all liabilities. When we look at these wholesale funds, Sukuk, syndications, interbank borrowings, those have increased around 16.3% in the first half of this year to reach 8.6 billion. Our foreign currency wholesale borrowings now represent 85% of this figure, and Turkish lira borrowings represent around 15%. During the first half of this year, we did manage to have successful capital markets transactions like rolling over our syndication, repaying our Tier 2 Sukuk, and issuing a new Tier 1 Sukuk. But we also mostly stepped up our issuances of Turkish lira domestic lease certificates or Sukuk to about 800 million liras. This represented a 70% increase year to date. So overall, our figures here are in line with our expectations as we had to sort of increase our Turkish lira domestic bond issuances to somewhat compensate for the lag in Turkish lira deposit growth. Subordinated loans represent 2.6% of all liabilities. The repayment of our 200 million Tier 2 has led to a decline in our overall subordinated debt from 1.6 billion liras to 1 billion liras. Our key factor in repaying this obviously was the largely illiquid nature of the instrument, and we felt it just made sense given that investors were not generally happy with its illiquidity. This obviously has had also a bearing on our Tier 2 ratio. Shareholders' equity now represents 8.1% of all liabilities. Shareholders' equity has increased 32% year to date to reach 3.3 billion liras. This increase has primarily stemmed from the $205 million Tier 1 Sukuk we issued back in February 2018, which had been classified under foreign currency line item of capital reserves. And let me very briefly go over the last few pages for the sake of time here. So in terms of customer deposits on slide 18, our aggregate funds collected increased about 10% in the first half of this year to reach 27.7 billion. Lira deposits contracted 2.3%. Foreign currency deposits increased 1.3% in real terms. Now, when we look at the breakdown of these collected funds in terms of where are they sitting, current accounts versus participation accounts, for the second quarter, the breakdown was about 27% in current accounts, 73% in participation accounts. In terms of currency denomination of those total deposits, roughly 47% were lira denominated and 53% were foreign currency denominated. In terms of underlying trends we're seeing on the deposit side, our lira current accounts did increase around 25% year on year, but declined about 11% year to date. Lira participation accounts increased about 0.3% year on year and increased 0.1% year to date. Foreign currency current accounts increased about 2.4% year on year in real terms, but declined 3.5% year to date. And foreign currency participation accounts declined 1.2% year on year in real terms and increased 4.2%. In terms of cost of funds collected, so the profit share expenses which are being paid to the participation account depositors for the last sort of 4 quarters on a trading basis, our Turkish lira cost of funding has increased about 147 basis points to reach 9.58%. Foreign currency cost of funding has increased 36 basis points to reach 2.17%. And average cost of funding has increased 77 basis points to reach 6.13%. On the deposit side, many of the dynamics we've been living with over the last 2 years have largely continued to shape our deposit collection performance, namely tight lira liquidity, combined with the elevated competition over lira deposits in the banking sector at large. And now, if we take a broader view and consider the roughly 12% year-to-date growth in deposits for the banking sector at large, and we subsequently take into account the deposit yield differential between our participation banking sector and the conventional banking sector at large, we are generally content with overall figures, although certainly disappointed with the lira deposit growth figures. In terms of slide 19, our off-balance sheet assessment, our total off-balance sheet commitments increased about 18% year-to-date to reach 13.5 billion liras for the first half. This represented about a 32% year-on-year increase. We have been seeing generally healthy growth across all main areas of off-balance sheet growth in terms of LG business and LC business. And the growth in this area is a reflection of the efforts being placed to continue to position our bank as an SME-friendly institution, which can help obviously our customers on the trade finance side. Now, this is obviously being matched by an active FI strategy to expand our correspondent banking network. If we move on to slide 20, income cost dynamics, I think I've gone through most of these dynamics in detail earlier in the call, so I'll just skip straight to projections and expectations moving forward, slide 21, where I'd like to give a bit more of our sort of thoughts. Now, funding-wise, customer deposits will naturally always continue to be a very core funding area for our bank. Total funds collected is expected by year-end of 2018 to reach about 29 billion liras, representing a 15% increase from the year-end 2017. In terms of market-based foreign currency borrowings, over the next 12 months, we do have 2 main rollovers, a syndication in April of 2019, as well as the 5-year sukuk maturing in June 2019. In collaboration with our sort of major and core relationship lenders, we do expect to continue to have a presence in global debt capital markets, albeit are prepared for different scenarios related to potentially lower rollover percentages and higher market access costs, which obviously, as we all know, will be tied to market conditions and the general macro picture surrounding Turkey. In terms of assets, loan book growth will continue to be mostly tied to deposit growth. The tight lira situation, I think, will also mean that lira loan growth will be somewhat subdued, with foreign currency loan growth contributing to the aggregate loan book growth. Now, since we focus on trade-oriented SMEs with export proceeds, growing the foreign currency loan book for us will continue to sort of be organic. Our total funded credits is expected by year-end to reach about 29 billion liras, representing a 15.3% increase from year-end 2017, while total assets is expected to reach 42 billion liras, representing another 15.5% increase from year-end 2017. In terms of profitability, we expect elevated deposit costs on both lira and foreign currency related to customer deposits to continue to exert some pressures, obviously, on our profit share expenses. Wholesale funding, specifically as it relates to our Turkish lira domestic sukuk issuances, is increasingly becoming an important funding growth area for our bank. Now, since pricing for these issues is linked to our central bank policy rate, we expect the rises we have seen in this area to start to slow down eventually, with funds borrowed funding costs to gradually stabilize as and when the rate cycle here peaks. This should help relieve some of the strong growth we have seen in profit share expenses paid on such funds borrowed in the domestic market. We also expect the recent decline in our core net profit share margin to gradually stabilize with time and to be somewhat compensated by an improvement in loan yields, which we do expect, higher trading income, and continued improvement in other fees and commissions. And as such, we maintain the guidance which our CEO Malik Shabi had provided earlier in the year, which is a year-end bottom line net profits of 400 million liras. In terms of page 23, market share for the first half. Now, in terms of market share change, looking at year-end 2017 to the first half of 2018, our share of assets in the banking sector has remained at the same level of about 1.1%, whereas our share of total credits has declined from 1.2% to 1.1%. With regards to collected funds, that share has increased from 1.3% to 1.4%. With regards to our relative position in the participation banking sector, share of assets has declined from about 22.6% to 21.8%, whereas our share of total credits has also declined to around 21.4%. So while there has not been any gain in market share in the first half of 2018 and a slight, in fact, decline, these figures do not, I think, faze us too much due to the fact that, yes, of course, we want to grow the balance sheet and grow market share, but at the same time, I think given the current dynamics, those equally necessitate a balancing of growth with an emphasis on liquidity and versatility, and as such, more of a focus on measured growth, which is something we are trying to do. When you look at page or slide 24, financial ratios sector comparison, I won't go into all of these figures. I think the main things to note during the first half of this year are as follows. Our capital adequacy ratio has declined below the banking sector average, due in fact to the Tier 2 repayment, but still remains fairly well above the BDDK comfort zone standards of about 12%, and of course the global standards closer to around 8%. Our provisioning ratio has remained flat at 57%, while the banking sector witnessed a material drop of almost 700 basis points. Our aggregate loan-to-deposit ratio is still relatively better than the banking sector at large, particularly as it relates to foreign currency, and this is, I think, an important attribute at this point in time. Our cost-to-income has declined about 552 basis points to reach 43.78%, while the banking sector cost-to-income has declined about 389 basis points to 34.80. So while our cost to income in absolute terms is still higher than the sector, we've seen a significant sort of gravitation more towards banking sector average. Our net profit share margin contraction certainly underperformed in comparison to the banking sector, whereas net profit share margins mostly remained flat for the banking sector at large. So having said this, I think this brings us to the end of our financial results presentation. Thank you very much for taking the time to join us on this call.